When most people look at a portfolio management service, they see a single corporate entity. But the tax reality is that the vault shatters. The assets inside, every stock, bond, and options contract, belong directly to the individual investor. This is the pass-through nature of a PMS. The portfolio structure itself pays no taxes. The tax liability bypasses the fund manager and occurs strictly at the client level. Because the investor directly owns the underlying assets, a single PMS account generates multiple conflicting types of income simultaneously. In a given quarter, a portfolio might trigger capital gains from stock sales, business income from derivative trades, dividends from corporate holdings, and interest payouts from bonds. Accurately forecasting a client's post-tax returns requires looking past flat-rate percentages and mapping every transaction through a three-dimensional tax logic tree. The first dimension of this logic tree is the investor category. We have to identify whether the client is a resident individual, a non-resident Indian, or a non-individual entity. The second dimension on the y-axis is the asset class: equity, debt, or derivatives. The final dimension is time. This z-axis tracks the holding period, introducing the 12-month and 24-month thresholds separating short-term trades from long-term investments. Every rupee of profit earned in a PMS must be routed through these specific coordinates to determine its legal tax rate. Collapsing the matrix into a logic tree, let's isolate the rules for a resident individual, starting with the equity branch. For equity investments, the critical timeline threshold is exactly 12 months. This divides short-term capital gains from long-term gains. If the portfolio manager sells equity shares in 12 months or less, the profit triggers a short-term capital gain, taxed at 20% under Section 111A. Shares held past the 12-month mark trigger long-term capital gains. These are taxed at 12.5%, with the first 1.25 lakh rupees of total annual gain being tax-free. Now look at the debt branch. This segment operates on entirely different parameters. For fixed income instruments, the dividing line between short and long-term capital gains extends to 24 months. Note this warning tag on the long-term debt path. Following the July 2024 rule changes, long-term debt is taxed at 12.5%, but indexation benefits have been removed. If the manager sells a debt instrument in 24 months or less, it registers as a short-term capital gain. These profits are simply added to the investor's total income and taxed at their standard slab rate. While equity and debt operate on different timelines, they both follow the structured rules of the capital gains environment. That structure is disrupted the moment a portfolio manager adds futures and options to the account. Watch this orange branch. Income from derivatives is never legally treated as a capital gain. It is strictly classified as profits and gains from business or profession, or PGBP. Because it is business income, derivative profits are taxed at the investor's standard income tax slab rate, regardless of how long the position was held. This classification also changes how losses are handled. You can use F&O losses to offset other business or non-salaried income, but the tax code prohibits using them to offset salary income. If a loss isn't fully offset in the current year, the investor can carry it forward for up to 8 assessment years to offset future business profits. This shift also introduces tax audit requirements. Depending on turnover volume, a mandatory audit is triggered if turnover exceeds 10 crore rupees, or if profits are low on turnover up to 2 crores. By introducing F&O, the client is no longer viewed as a passive investor. In the eyes of the income tax department, they are now a business operator. This legal standing leads to a significant investor misconception regarding the operational costs of the PMS itself. Running these portfolios requires management fees, performance fees, brokerage, and an 18% GST. Despite being necessary to generate a return, these fees are strictly non-deductible when computing capital gains. You only subtract the acquisition cost from the sale price. The management fees cannot be written off. If an investor treats their entire portfolio as a trading business, these expenses might become deductible. However, this means opting out of lower capital gains rates in favor of business income tax slabs. Since expense write-offs are impossible for most investors, tax optimization relies entirely on asset allocation and holding periods. Now, rotate the logic tree 180 degrees. The matrix must adapt to address the unique regulatory hurdles faced by non-resident Indians. Traditionally, an NRI trading Indian equities directly must use the RBI's Portfolio Investment Scheme, or PIS. It is a slow, complex administrative process. But for NRI investments routed through a PMS, PIS approval is not required. The structure allows the investor to gain market exposure while bypassing that specific regulatory bottleneck. However, NRIs face a more intense tax-deducted at source environment. On short-term equity gains, a 15% deduction is applied automatically at the source. Dividend payouts are also affected. While taxable at the NRI slab rate, dividends are subject to a baseline 20% TDS before the funds reach the client. NRIs can trade derivatives within a PMS, but the tax code restricts this to non-repatriable NRO accounts, meaning the funds must stay within India. The PMS structure simplifies entry for NRIs by bypassing the PIS requirement, while the portfolio manager handles the high-volume TDS compliance on their behalf. This completed logic tree reveals a complex matrix of intersecting timelines, asset classes, and specific deduction rules. For an individual investor, managing the compliance burden of this pass-through system manually would be nearly impossible. SEBI Regulation 30 addresses this. It explicitly shifts the compliance and reporting burden off the investor and onto the portfolio manager. This results in the periodic taxation report. This mandatory document distills the logic tree into clean line items, separating long-term capital gains from short-term, isolating business income, and documenting every rupee of dividend TDS. Managers provide these reports quarterly, culminating in an annual summary that clients use directly for their income tax filings. Distributors who internalize this logic can translate these reports into accurate post-tax projections, providing the technical expertise necessary to align a client's expectations